everyone. Welcome to Emkay Macro Moves. This is Madhavi Arora, the Lead Economist at Emkay. I'm Harshal Patel. Today we're going to talk about the overall global disorder and global uncertainty that we've seen over the last couple of months and even longer, and what impact this could have on the RBI's monetary policy decision this Friday. So, Madhavi, over the last couple of months, as I said, there's been a lot of global disorder, chaos, uncertainty. We've had a hotter than expected CPI print for August in the USA. We've had, just a 75 basis point hike by the Fed as well. There's been a lot of chaos in Britain over the last 3-4 days with their mini budget and the sell-off in British risk assets that has followed. There's been a lot more concerns around the Russia-Ukraine crisis as well, with Russia sort of mobilizing troops, and there's potential escalation that can happen there as well. So while maybe at the start of August or so we could have thought that maybe there's some little bit of order coming into markets, but that's again been smashed. There is still a lot of disorder. So how do you think this is going to impact, or just in general, how do you see this going forward, or how could it impact things?
So clearly, uncertainty is a new word, which is probably going to stay for much longer than most of us expected. We had been cautioning clients on the same that probably there's a lot of complacency with regard to what is in order for us, and the things that you mentioned are probably I'm not seeing any of these settling down in the near term. Now we also have a new angle of China, which is going in a different direction altogether. The way the currency moves have happened, especially be it the Britain disorder or be it the Chinese yuan devaluation, which is obviously having implication for most of the emerging markets, and more importantly the kind of consistent repricing of Fed rate hikes, which is not something the market had anticipated, has also added to further uncertainty as to how hard the landing is going to be. So clearly we are in a state where emerging markets are not left with much choice as far as deciding on their policy making just based on growth and inflation dynamics. It obviously goes beyond that to financial sector, the disruption that the global financial order is bringing to emerging market, and clearly to that extent we are sort of strong armed by the Western world. Wherein even though we did not really see much of fiscal impulse from our policy makers, including that of India, we are essentially going in tightening much more than what we need to, just to ensure that we are giving a fair premium to the world as far as our asset classes are concerned. So clearly it's going to be a tightening without the comfort of most central banks in the emerging markets. So we are in for a difficult time, I think.
So, having said that, you also, as you mentioned, of course, we've seen the rupee falling by quite a bit. I think it's down about 9%,
Right.
over 9% this calendar year. So, how much of an impact or how much of an influence do you think now on Friday when we see the RBI's decision? In terms of the trade-off, how much do you think they're going to weigh the rupee versus, say, the growth parameters, or the fact that inflation is also above the 6% level, right, which is the upper band of the tolerance level? They need to consider that as well. So all of these factors, how much do you think it's going to weigh on the overall decision?
So I think until August, INR was not necessarily the Reserve Bank priority to that extent. I mean, of course, they have been defending the rupee since beginning of the year. To our understanding, I think they have spent more than 110 billion worth of dollars to support the currency, which is I think the highest defense in the history of Reserve Bank. And as we've been mentioning to the clients as well, that the war chest is already declining very fast, but the war is still pretty much on. So that pressure is now mounting on the RBI, because all this while they kept the rupee artificially a little appreciated against the peer, even though on absolute level we saw the rupee falling. The kind of overvaluation in which we have seen the currency is obviously going to cost us in some form or the other in terms of external imbalances, and the rupee has to be essentially falling in line with the rest of the world. I think RBI finally has realized that it's a lost battle for them as far as defending currency is concerned, and that is why maybe in the last couple of days the kind of catch-up the rupee has done is much faster than the emerging markets, barring today's print, of course, where rupee again has been an outlier, where RBI has been supposedly defending the currency again. But I think on a broad basis, I think a couple of days trading returns have sort of shown us that RBI probably will let the rupee be to some extent and let the depreciation play its course. And to that extent, they also have realized that any kind of policy making which has to be done going forward has to keep in mind the impending pressure on the rupee one, and two, the disruption that it can bring to such classes if you are probably looking at giving a signal which is relatively less hawkish than probably needed as far as the growth and inflation dynamics are concerned. So I think the cost of them being relatively more shallow in terms of rate hike in the immediate run could be much higher for growth in the medium term as far as them trying to reach a steady state is concerned. So I think to that extent, my sense is that they're going to go ahead with another front-loaded 50 bips hike, pretty much in line with the most emerging markets that you've seen in the last week or so, where most of the Asian central banks have been sort of tied to the Fed and have increased their rate by 50 bips plus. So I think another front-loaded rate hike by the RBI is sort of priced in by money markets also.
Yeah, so assuming we do see a 50 basis point hike on Friday now, where do you now see, say, the RBI maybe pausing, or in terms of just generally, how do you see the interest rate dynamics over the next, say, 6 months or so? Where do you think they'll take a pause, or they'll sort of try and assess whether more hikes are needed, or is it just a case of them being tied to the Fed now, that as long as the Fed is hiking, we need to hike?
So I think the situation globally is extremely fluid. I think the assessment of the macro order has to be done much more frequently. I don't think any central bank wants to be tied to any guidance as such. But our understanding is that if you want to even take their policy rates to a neutral level, I think 6.25% is something that probably will bring them to a forward-looking real neutral rate, wherein inflation is supposed to be probably ending the year at 5.3, 5.4%. And RBI could still reach a neutral rate, which is not very restrictive in order. So I think to some extent, till the time they don't reach their supposed neutral level, which is 6.25 as per our calculations, I don't think that they would be giving a further guidance. So I think in the next 3 months or so, this should be your first point of stopping their rate hike, and probably reassessing rather than stopping. As to from there, whether they need to get further restrictive on their rates, or probably take stock of the economy. And also I think a lot would depend on how the global financial order is, because eventually the recent movement in the reaction functions of most emerging market has been driven by not their inflation or growth dynamics only, but the fear of financial sector disruption which could flow in their asset classes. So if that is sort of controlled in the next 3 months or so, I think there could be a fair chance that policymakers could get little more cautious on their front-loaded tightening. So I think at this point in time, given the way global markets are, I think it's extremely fluid and extremely uncertain to really give a stop point for policymakers. I think they might at least reach their neutral rate, which is going to be close to 6.25, and from there take stock of the economy and see how it goes. Thank you, guys.
Thank you so much for this discussion, Madhavi. It was really, really helpful and really enlightening, and we'll see you next time.
Thank you.